Hi, I'm Justin Nielsen with Investors Business Daily. In this section, we'll cover the technical analysis of tops to show how charts can help determine the right time to sell your stocks. But before we get into that, let's ask the question, why is selling so difficult? One big reason, it can be very hard to keep your emotions out of your sell decisions. When you're down on a stock, have you ever said to yourself, "Oh, it'll come back, it's still a good company"? Rather than admit you might be wrong, you start justifying to yourself why you should hold on to the stock, hoping it will come back eventually. You might be stubbornly asserting that you are right and the market is wrong. Well, if you invest in stocks long enough, you'll come to realize that the market is always right. Your job is to react accordingly. It can be hard, but admitting that you're wrong early can get you out of a stock while the damage is small, rather than waiting until the stock goes down much further for a huge loss of capital. Now, what about taking profits? This too can be very emotional. Part of you might feel greedy. If the stock keeps going like this, think of how much money I'll make. Or you might be feeling fearful. I've got a good profit now. What if I lose it? Now, these are all valid feelings, but they aren't necessarily going to lead you to the best decisions. Emotions are your enemy in the market. The best strategy is to have sound rules in place and then act on those rules when the time comes. So let's go over those rules right now. As you know from our earlier session, we make our buy decisions using both fundamentals and technicals. However, for our sell decisions, we're mainly going to use technical analysis alone. The reason is that when stocks top, the fundamentals often look very good. The market discounts changes in the outlook before they happen. Let's go ahead and take a look at an example. Here's a weekly chart of Yahoo as it topped in 2000. Now we've overlaid in black the trailing annual earnings per share. Now, as you can see, the stock actually topped 4 quarters before the earnings peaked. This is frequently the case. Institutions, mutual funds, and hedge funds pay close attention to future earnings estimates and whether those estimates are getting revised up or down. Stocks will often top and distribution will begin before the fundamentals begin to deteriorate. So don't wait for the fundamentals to confirm what the price and volume action is already telling you. In the case of Yahoo, the stock dropped from $250 down to $11 before the EPS actually turned negative. If you had waited that long to react, your portfolio would have been devastated. So what technical action do we look for when we want to sell our stocks and nail down a profit? We're going to be looking for climax top action, signs of weakness, or a change of trend. Now, an important thing here is we are going to be doing most of our focusing on the daily price and volume action here. The weekly is also going to give us some clues, but daily is where we're going to do a lot of our focus. Let's go ahead and start with climax tops. Now, if you can memorize these very simple signals, you'll be able to recognize climax tops and sell into them without a second thought. One important thing to remember about climax tops is the best of the best stocks top this way. So let's take a look at some of the things that we're going to be looking for. The stock going up 25 to 50% in 1 to 3 weeks after already having an extended run. If you have your notebooks out, underline this part because it already has to be extended from a previous price move in order for it to be a climax top. There has to have been some action in it already. Now also, if the stock stages its biggest daily price gain, if it has 7 out of 8 days up, the widest weekly price spread, exhaustion gaps. Now, we've talked before about gaps being a positive thing. Exhaustion gaps are a different animal by themselves. If you see exhaustion gaps at the end of a move, this can be a negative. This can be a sign that the stock is really getting out of control, the rally is getting out of control, and things are getting ahead of themselves. So you need to be aware of this. This can act as a signal in a negative way. Closing excessively above the 50-day or 200-day moving average, breaking through an upper channel line. Again, this is a signal that the rally is getting out of control. And then also excessive stock splits. Now let me just stop real quick to say that with excessive stock splits, we're looking at 2 different things here. Number 1, the frequency of the stock splits. In other words, if you're having 2 or 3 stock splits in the span of, let's say, a year, that can be a sign that there's a high frequency of stock splits. The other factor is looking at the split factor. If you have 2 for 1, 3 for 1, 4 for 1 splits, once you start getting into that 4 for 1 split factor, it's a sign that the stock may be really extended, and so you need to start looking for signals that the stock might be topping. It's just something that you have to be more aware of. It doesn't mean that you necessarily sell because you see excessive stock splits, but it's one of those things that puts you more on red alert. Let's go ahead and see how these rules play out in a stock. This is Charles Schwab back in 1999. It had this big move from October 1998 where it broke out and made a 428% gain in 6 months. Now the climax top happened in April of 99, and you can see right here on the weekly chart there was a wide weekly spread followed by a reversal and then a real devastating week down where it came down to the 10-week moving average and then came back up. So a lot of wide spreads in the climax top range. Let's take a look at the daily. Now one thing that you can see on the daily here is from the breakout point in October of 1998, the stock had already gone 234% gain before it made its climax run. And that climax run had about a 60% move in the last 7 or 8 days of its move. So it was going at this very quick speed already and then accelerated to an even faster speed, going almost vertical. And that's a clear telltale sign of a climax top. A couple other things that you would have noticed if you were zooming in and looking at the daily action on Charles Schwab. You had that 60% move in 8 days, the largest daily price gain, where it was up $15.50 in one single day. That was following an exhaustion gap. So it had already made this big move and then went up more than 10% in a single day. This is, again, a sign that the rally is getting out of control. There's just too much of a frenetic buying out there. You saw the volume increasing, especially when it hit that highest daily volume of the entire move, when it was having that big 10% move in that one day. Now, one thing I also want to point out is if you look at the few days that happened after Charles Schwab topped, in 4 days, it was down 38%. So one thing you have to realize with climax tops is they come up very quick and they also can get hit hard very quickly. So you really need to be selling into that surge. You need to take advantage of the opportunity to sell into the strength, because if you wait too long, you're going to see your profits evaporate very quickly. One final thing with the Charles Schwab example here. If you look at where the stock was in relation to its 200-day moving average, it was 226% above its 200-day moving average. Now, why is this important? Well, in our model book studies, we've looked at a number of the past winners, and we know that the average for these past winners, when they top, is for them to get extended about 100% above the 200-day moving average. So only 5% of past great stock market winners ever rose more than 200% above their 200-day moving average. And this is, of course, during bull runs. So the fact that Charles Schwab, at its peak, was 226% above its 200-day moving average could act as a warning sign. This stock is well extended above its 200-day moving average, and this isn't necessarily a signal by itself that you should sell, but again, it's kind of bringing up that you should be on the lookout for other sell signals, and they were definitely there, as you had the exhaustion gap, the quick move in a very short period of time. So you had a lot of other signals there that you might have been alert to by that 226% extended above the 200-day moving average signal. So again, here's a recap of our climax top signals. Once you start recognizing these, they're very easy to see in the big stock market winners. And 8 out of 10 of the best winners top this way. So it's very important that you learn these signals. One thing also I will just quickly warn you about is that you have to be aware of your emotions during this time. When you have a stock that's going up 10% in a single day, you're going to be very excited. Your emotions are going to be you're going to be ecstatic about this. But you have to really look at the rules. The rules will save you here. Your emotions will get you in trouble. When you start feeling so ecstatic about the stock, like this is the stock that you're going to retire on, that's a warning sign. So just really keep your emotions in check. Our next topic is signs of weakness. So here, a lot of times the stock is already topped and we're kind of seeing it come down on the downside, or we might see it just running into trouble as it's trying to make progress on the upside and it's just not making any headway. So signs of weakness is the next thing we're going to be looking at. And here are the major signals that we look for in terms of signs of weakness. Churning, this is when a stock is near a new high, but it just can't make progress on the upside. A lot of times you'll see very heavy volume, but the stock price is not making any progress. New highs on low volume. Now, new highs are great, of course, but when they start happening on low volume, this can be a sign that the demand isn't there for the stock at that price level. So this can be a warning sign as well. A rebound rally on light volume. We're going to take a look at this. This is when you have a stock coming down and it rebounds, but the rally is on very light volume, which again, it kind of shows you that there's a lack of demand out there for the stock at that price level. Lagging relative strength is another thing that we're going to be looking at. If you see the relative strength line lagging, this can be an early signal to you that the stock is not holding up as well as it used to. And this can be a sign that there's weakness out there and that there are better prospects out there for you. And then finally, there's the third, fourth, or fifth stage base. As a stock gets extended in its move, once it's at the third, fourth, or fifth stage base, this is a late stage base and can be a signal that the stock might be nearing its end, because normally stocks only go through 3 or 4 bases tops when they're the best stock market winners out there. So once you start looking at these later stage bases, you should be a little bit wary that you might be close to the top. Let's look at some examples of what these look like. Churning near new highs. Here we have EMC Corp, and this was back in 2000. The market had topped in March of 2000. It came down and then rallied back, and this stock topped in close to the September area of 2000 after rallying back a little bit during that market uptrend. And what you found is that while it was rallying up into this new high territory, it was getting past 100, had broken that level, and as soon as it did that, it just kind of stopped. The volume increased, so the volume was coming in there, but the price was showing absolutely no progress whatsoever. After that first break into the 100 area, the stock just kind of went sideways and wasn't able to make any further progress despite the fact that the volume was so heavy. This is what we call churning. It's kind of like that idea of if you're driving up an icy driveway, the wheels can be spinning, but you're just not making any progress up that driveway. You're not gaining any traction. And so that's the feel that you will have with churning when you see that in a stock. Other signs of weakness, we have the new highs on low volume. So on the left-hand side of your chart book, you can see that this stock had kind of broken out of a one-week pullback, broke out into new high territory in the $56 range, and there just was absolutely no volume to back that up. That just meant that there wasn't demand for the stock at that price. Now, there wasn't a lot of selling either, which is why the stock was able to go up in price, but that lack of demand should kind of scream out at you that there might be a problem here. The mutual funds aren't necessarily supporting this stock. They're not interested in the stock at this price, and so that should be a warning to you that maybe the stock is close to its final legs. Now, on the right-hand side, we have a rebound rally on light volume. You can see how this stock broke above the $45 range and had a very sharp pullback in one day. And now if you had held on to the stock through that sharp pullback, you would have been a little bit heartened to find that the stock was making progress up again. However, if you looked at the volume behind that upward rally, there was no volume. This should be a warning sign when you have such a strong day down, followed by upward price movement without any volume. This has got to scream at you that there is a problem with the stock. There's no demand for it at that level. The mutual funds are not jumping in to support it, and so this has got to be a big warning sign for you. Other signs of weakness, we have the relative strength line lagging. You can see here, with the relative strength line, we're not looking at any particular scale. We're just looking at where that relative strength line was in the past and where it is currently. So we look at those previous highs for the relative strength line to kind of give us a gauge of where the stock is in terms of its strength relative to the S&P 500. So in this case, you see that the stock made a new high in its relative strength line, and the price was also at a new high. Now, it went through a base, but as it's breaking out of this base, getting into new high territory, you would like to see the relative strength line getting into new high territory as well, but it's not. It's nowhere near that previous high, and this is a signal that the stock is lagging. It's no longer one of the leading stocks of the market. Even though the price is going up, it's still lagging the rest of the market, and that's a big warning sign. Now, on the right-hand side, we have an example of a stock that went through multiple bases. It had a big long base as its first base, a short second base, and then a little bit longer third base. Once you get into that fourth and fifth base, you should know that the stock might not have many legs left. This is not necessarily if something is in its 4th or 5th stage base that you sell immediately, but it's got to put you on red alert that this stock has already had a pretty big move, and you've got to recognize that if sell signals start mounting up, you're going to want to get out because you don't want to get caught in a downturn for the stock. Now, we often get a lot of questions on stocks like Cisco or Microsoft that have had multiple stages of bases over a long period of time. And how do you decide that it's okay to buy a stock after it's already been extended? Well, what we look for is we look for a sign that it's kind of reset the base count. So what you're looking for here is action by the stock that it's kind of shaken out or worn out a lot of the investors, the weaker holders. So you're looking for an opportunity where the stock has just kind of undercut previous support levels, or that there's been long enough time that most people that are the weaker holders wouldn't be able to hold through it. So let's take a look at Cisco. You can see that Cisco, and again, this was one of the big stock market winners of the 90s. It had gone up over 75,000% from 1990 to its top in 2000. And you see here from its initial base back in November of 1990, that was base number 1, and then we have 5-6 bases that it formed. Now what we're looking for here is an undercut of a previous low from a base. So you can see where when it formed base number 6, the bottom of that base came down considerably, but it did not undercut the low that was reached in base number 5. So that does not count as an undercut. However, once it broke out of base number 6 and made some progress, it formed another base. Now this base did undercut the previous low set by base number 6, and it also took out the previous low set by base number 5. This resets the base count. So if the stock is able to form a base from this downward action, if it is able to come out of it and form a base, we would consider this base number 1. It's reset the base count, we start counting over. And that's exactly what happened in this case. Cisco ended up forming a long cup with handle during the 1994 market correction. It broke out of that and went on to make even larger gains. So here again is your list of signs of weakness. A lot of times you're going to see these very close to the top, not necessarily when the stock has made its downward move yet, but these can be early warning signs close to the top. Now, change of trend, this is something that you'll often see when the stock is on its way down. You're going to see the stock falling below its 50-day moving average and continuing to trade below it. We call this living below the 50-day. You might see the largest one-day price drop, or you might see a long-term uptrend line broken. So let's look at what it looks like when the stock trades below its 50-day moving average line. Now the 50-day moving average line, or if you're looking at a weekly chart, it corresponds to the 10-week moving average line. This is a line that is often known as a support level by many institutions. Remember, institutions, mutual funds, banks, they've got a lot of money out there, and they don't buy all at once. They buy over a long period of time. A lot of times, they look at pullbacks to the 50-day moving average as an opportunity for them to add to their position. When the stock gets down to that level and mutual funds are no longer interested in buying it, that shows a lack of support, and that can be a warning sign that the stock is no longer getting the interest of mutual funds and banks out there. So in our example right here, we have JDS Uniphase. JDS Uniphase was going through this very big move, went over 2,000% in 15 months when it broke out in October of 1998 to its top in March of 2000. And during that time, you can see how it came down to the 50-day moving average. In this case, it's a 10-week moving average because we're looking at a weekly chart. It came down to that 10-week moving average a number of times, but never really broke significantly below it, and it never stayed below there for very long. This kind of ended up being part of JDSU's personality. This stock didn't decline below that 50-day moving average, and we would say that the 50-day moving average was able to contain the move. Now, in March of 2000, that's when JDS Uniphase had a personality change. It broke the 50-day moving average for the first time and did so pretty significantly. Now, granted, it did rally back, but then you can see that it immediately turned tail again. So it wasn't able to break above that 50-day moving average line, and JDS Uniphase pretty much went down and fell apart from here, as did most tech stocks in 2000. So with JDS Uniphase, your first signal was when it broke the 50-day moving average significantly, and the volume was very heavy. It meant that mutual funds had kind of ditched their support temporarily. Now they did come in and bring it right back up to the 50-day moving average, but the next week it went right back down again. You can kind of look at the 50-day moving average as acting as a floor when the stock price is trading above it. A lot of times it'll bounce off of the 50-day moving average line just as someone would bounce off the floor. But once it breaks below that, that 50-day moving average line can often act as a ceiling. The stock will try and jump up and it'll kind of be hitting its head on the ceiling and then get smashed back down. So when you see it breaking the 50-day moving average, especially on significant volume, and the support never comes in, that's a warning sign that the stock might be done with its move. Now here's a great example of how that 50-day moving average line was acting like a ceiling. In this case, with Glenair Technologies, it had broken the 50-day moving average, and again, it tried to rally back up above it and was able to do so for just one day before the next day turning tail again and going right back below the 50-day moving average. It tried again a few days later to break above it, wasn't able to, and turned tail again, and then the selling started increasing pretty dramatically as it started going down towards its 200-day moving average. You don't necessarily want to wait too long, because if you wait for it to get all the way down the 200-day moving average, it's already lost a lot of support by that time. So you've got to kind of act quickly, because these stocks can go down very fast and very hard. Now here's an example of a largest one-day price drop. Whenever you see a significant drop, especially on very heavy volume, this again, it doesn't mean that you're necessarily going to sell automatically, but this is a sell signal that should get your attention. It should be making you look at, does this stock have other sell signals? How far is it extended from its last base? How much profit do I have in this stock? And you might start thinking about taking some money off the table. Now in this case, the stock had come down to its 50-day moving average. It rallied back up. Now this is an example of a rally on weak volume that we talked about with our signs of weakness. So you had this rally back on weak volume, and then immediately following that, you had a large one-day price drop. It went down $2.68. It was the largest price drop that the stock had ever had. It had another rally on very weak volume, followed by an even larger one-day price drop of $4.14. Now, if you're selling at any point in this area here, you're probably going to retain most of your gains. But if you wait too long for it to go all the way back down to the 200-day moving average or even lower, you're just going to be watching your gains evaporate. So we don't want that to happen. We want to retain as much of our gains as possible. It's not our intention to sell necessarily at the top. If we do, that's great, but we're just trying to get out close enough to retain the majority of our gains and our profits in the stock. And one thing about that drop of $4.14 in this stock, you can see that also corresponded to a break of the 50-day moving average. So one thing that's important to understand about these signals is you're not just getting one signal necessarily. It's usually multiple signals that are hitting a stock at the same time, and so you've got multiple opportunities to react to these signals if you know what you're doing. Now here's what that stock looked like on a weekly. It's a little bit tougher to see on a weekly, so that's why sometimes looking at both the weekly and the daily charts, and especially for selling, you might focus a little bit more on the daily charts because you're going to be able to see those details a little bit better. Now here's a weekly uptrend line, and what you do with an uptrend line or any trend line that you're making, it's very important to realize that number one, you need to have it over at least 3 points. You don't want just 2 points because you can have a lot of disparity between the different lines that are possible. So 3 points is the minimum that you'd like to see when you're drawing a trend line. And you want to see those 3 points extend over a certain period of time, at least several months. You don't want just 3 points that are a few weeks apart because, again, that's not going to give you much of a solid trend that you're working off of. Now, one other important point is when we do trend lines, we're using it off of weekly charts. Weekly charts are logarithmic if you're using our IBD charts or our Daily Graphs online products, and the logarithmic nature is going to give you a truer trend line to follow. So it's very important that you do this off of weekly charts. You're using at least 3 points and that it's over a period of several months. Now, when you're drawing an uptrend line off the lows, you're going to just be connecting 3 different lows. And what you're looking at is once the stock breaks that trend line that you've drawn, this is a sign that the stock may have changed its trend. This will often correspond to a break in the 50-day moving average, either shortly before, at the same time, or shortly after this break in the weekly uptrend line happens. But this just acts as another signal that the stock is now changing its personality. It's no longer showing the strength that it once was, and so you have to start considering whether or not you're going to be taking some profits off the stock. So we mentioned earlier that we never use PE ratio as a means of establishing whether we're going to buy a stock or not. It's just not a good predictor of future price performance. However, sometimes we will use PE ratios to give us an idea of the potential in a stock. And the reason is because we know that in our models of great stock market winners, that the average PE expansion from the first stage base of a stock was around 130%. So how do we use this? What we can do is if we look at what the PE is at a first stage base, we can calculate out what kind of price target is possible for the stock. Now here's an example. America Online, its pivot was at October 26, 1998. The PE at that time was 205, much higher than most people would ever consider buying a stock if they wanted a good quote-unquote value. Now at its peak, in April 6, 1999, the PE expanded 532. So already from a high level, the PE was able to expand 160%, and it just kind of shows you that if you look at historical precedent, it will alert you that stocks can make these huge PE expansion gains, and if you kind of calculate out what the price target could be based on that PE expansion, it can kind of give you an idea of the potential of the stock and give you a little bit more conviction on holding it. Now, one caveat to this rule is that it's very important that you've got a good, solid bull market that you're using it in. PEs for growth stocks generally aren't going to be expanding in recessions and things like that. This is in a good growth bull market cycle. So that's one thing that we know from our research does happen. Again, the average is around 130%. Now that we know the rules, let's see how we could have applied those rules to some historical examples. Our first example is SanDisk Corp. From December 2003. SanDisk is a maker of memory storage products, and as you can see, the earnings and sales growth was phenomenal when it was at its top. Triple-digit earnings growth and double-digit sales growth. This kind of goes to the point that we do not look at fundamentals when we're making our sell decisions because they often do look the best when they're at the top. We look at the technical action, and that's a much more reliable sign of whether your stock is topping or not. So you can see that SanDisk had a cup-shaped base and then quickly made a 100% move in under 6 months. Now you see that we've drawn a line here. This is a good example of an uptrend line. We've got 4 points that the stock touched on this uptrend line, and the line is drawn over a period of months. So that gives us conviction that the stock was catering to this line and not violating it. Now when it does get into trouble, you see that there's volume picking up on these 2 weeks down as it goes below the uptrend line and pulls back to the 10-week line. So that's our first signal. Now it tries to rally back up on very low volume, no volume whatsoever when it tries to rally back up, and then the very next week it crashes through the 10-week line on very huge volume. So this is your final signal to get out of this stock, and you can see that for that week it closes at the low, so there's no reason to be sticking around at this point. Now, we started with the weekly because it gives us kind of a big picture look at the stock. Let's go ahead and take a look at the daily and see a little bit more detail. So on the daily, you can see that it had that big uptrend, and the first sign of trouble was when it started breaking into new high territory and the volume was pretty light. Now, this wouldn't have been enough to make you jump out of the stock right there, but it does kind of put your ears up, making you pay attention to other signals that might be coming along. And then, of course, as we saw in the weekly, as the stock pulls back to the 10-week moving average, keep in mind this is where it broke its uptrend line, but as it's making this pullback, you see the volume having a huge increase. Stair-stepping volume is what we call this, where each day was getting higher than the day before as it's pulling back to that 10-week moving average. That alone might not be enough to panic you, but because it also broke the uptrend line and this was happening, it should really get your radar up. Now, as it does try and rally back, you notice that the volume diminishes. There's no volume there whatsoever as it tries to make that rally back. And then this is our key day here where it breaks the 50-day moving average and it closes at the low. Now, if you had waited till the end of the week, you would have been all the way down here. So sometimes it pays to act quicker and protect your profits when you see these warning signs. And the breakdown just continued and got worse from there. Let's look at our next stock, Sanfilippo, John B. & Son. This company was a maker of nuts and peanut butter and candy and snack foods. Nuts aren't a new product necessarily, but during the Atkins craze, a lot of people were on these high-protein diets, and Sanfilippo did benefit from that. Again, we see those phenomenal earnings growth at the top here, but we're not looking at that. We're going to be looking at the technical action. You see it came out of a double bottom base and made a very quick move in a short period of time. You might look at this and say, is this a climax top right here? But remember, a climax top really has to occur at least 18 weeks out of a base. So that's nowhere near 18 weeks, so not a climax top. It's too early for a climax top at this point. You see that the 10-week moving average really contained this move. It never had any significant violations of that 10-week moving average, not even close in fact, until you get close to the top. So first you go into new high ground and you reverse sharply and close near the lows. So this is a warning sign right here. The volume picks up in a large way from the week before and is also on above average volume. So this is our first clue. You come back a little bit, try to rally, but look what happens to the volume. The volume is sharply down, so there's no support for it at that price level. The mutual funds, the institutions, they are not jumping into the stock trying to support it. Then, just like our last example, you get this crash through the 10-week moving average. The stock has now changed its personality, whereas that 10-week moving average, it never broke that before. Now that it's violated it in a big way. And you see that the stock closes near the lows for the week, and the volume is the largest volume that the stock has ever shown. Let's go ahead and take a look at the daily to see some details on this one. So here we can see that weakness that was occurring at the top. On the daily, you see that reversal that happened where it broke into new high ground, but then quickly reversed. Wasn't able to hold that price level. The volume was very high at that point and then got even higher as it had a very sharp move. The largest one-day price drop of its entire move, it was down $5.43. So that's a huge amount for the stock. It was only trading at around $55. So that was more than a 10% move down in one day. This is a big warning sign right here. So you might have been unloading some stock in this weakness. Now, it does come down to the 50-day moving average. The volume had really picked up, and then it bounces off that. It tries to rally from that 50-day moving average. Now, the price action is positive with that regard, but again, the volume tells a different story. There's no volume support there for that price action. So this is a huge divergence and a warning sign for us. Now, the stock gaps down. That's not good. And the very next day, it breaks below the 50-day moving average and closes at the low. Now, just in a matter of a short period of time, just from the top here to the pullback to the 50-day moving average, keep in mind, you quickly found yourself in a matter of days down 20% off the top in this stock. Now, that's something that can happen frequently, especially in a stock that has lower liquidity. This stock was only trading at 292,000 shares a day, so it was a little bit less liquid stock. So you've got to be aware of that when you're trading less liquid names. They will be more volatile, and you can find yourself down 20% in a matter of days. So that's just something that you have to kind of prepare yourself for when you trade the thinner stocks. But there were some signs here that should have gotten some action from you. And again, with this rebound on very low volume, that was another sign. And the final sign was that break below the 50-day moving average. So multiple signs occurred. You had to act on one of these in order to protect your profits. Now let's take a look at our next stock. This was NetEase.com, one of the Chinese internet stocks that had a huge move in the 2003 timeframe. Again, the fundamentals were great. It was coming out of this double bottom base and had a very powerful move. Went from $20 to $70 in a very short period of time, in under a year. And there was a definite personality to this stock. You can see how every time it came down to the 10-week moving average line, it bounced right off of it. Never really violated that line. So that kind of showed a personality to this stock. Now, here we have a change in personality. This is a change in trend where now the stock has broken through that 10-week moving average line, and look at the volume. The volume tells you a lot right here. It's the largest volume week of the entire move. The volume is so much significantly higher here. So you've just really got to pay attention to that. If it had broken it on very low volume and hadn't crashed below that 10-week moving average in such a dramatic fashion, you might have been able to hold this stock for a little bit longer. But this is really screaming at you that there is something wrong with this stock, and you don't want to wait too long because these can come down very quickly and very hard. Let's look at some details on the daily. So here on the daily, we see that huge move that the stock made, and we see how it has multiple times that it found support at the 10-week moving average, or in this case, the 50-day moving average line. And you can see that in a lot of cases where it does find that support at the 50-day moving average line, the volume confirms that bounce off the 50-day moving average line. So it's acting right as it's pulling back and bouncing off that line. Now, let's look at the top. We start with a downside reversal day. It goes into new high ground, and it can't maintain it, closes at the low, volume's picking up. It's not finding support at those price levels, and people are starting to abandon the stock a little bit. That by itself isn't necessarily going to make you sell. However, the trend does continue in a very dramatic fashion as it pulls back to the 50-day moving average and the volume really picks up. Now in this case, if you compare the volume on the way down to the 50-day moving average versus the volume as it bounces up from the 50-day moving average, you see a very different story. There's a trend down as the volume lightens on the rebound compared to how it was increasing. Again, you get that stair-step fashion of increasing volume that happened as it was pulling back. So there's a big warning flag right there. Now, before that weak rebound rally, you also had this dramatic price drop, a $7.90 price drop on huge volume, the largest one-day price drop of the entire move, and keep in mind, that was more than 10%. It lost more than 10% in a single day. That really should be getting your attention. After the weak rebound rally, the stock got into new high ground again, but the volume, even though it's above average, it's still well below the levels it was at that pullback. So again, the price action is telling you a different story than the volume action here. So that should be a warning sign. And then again, you get another largest one-day price drop. In this case, it's $8.05 on even larger volume than previously. So again, is not the action you want to see. The volume is increasing in a huge way on these very dramatic price drops, and the stock was closing at the low for the day. So it was just really not finding support throughout the day. No institutions were jumping in to support the stock, and it does come down to the 50-day moving average. It does bounce again, but the volume, even though it's above average, it's still significantly below that pullback. After the rebound, you get this real dramatic gap down through the 50-day moving average. Now, if you hadn't paid attention to the signs before, if you hadn't unloaded any stock before, this is your final wake-up call that this stock is topping. And if you wait too long to act on such a dramatic price drop on the largest volume that it's ever had, over 19 million shares traded on that day, so well above its average daily volume, significantly above it. If you waited much beyond that, you were going to find yourself in real trouble very quickly. Now let's take a look at Taser. Taser was an interesting example because it had this dramatic move up. It was contained by the 50-day moving average, or the 10-week moving average line in this case, all the way up to the top. But there were a couple signs here that you might have been looking at that looked very much like a climax top. And then the stock actually ended up going higher. So it was a little bit tricky to hold on to this. If you were following our system, you might have been faked out by a couple things that did look like climax tops, but the eventual climax top did happen at the very top, and the stock really never came back after that. Let's see those details on the daily chart. So on the daily chart, remember this is a split adjusted price, so it's not like this buy point you see at $2.25. That's not the price that we were buying it at. Of course, we don't buy stocks that are $2. Split adjusted, the stock was well above $10 at that point. Now you can see here all along the 50-day moving average line, it was finding support, finding support. Now this is the area that kind of looked a little bit climactic right here. It made a very sharp move up over 50% in under 3 weeks. You had what looked like an exhaustion gap. So there were signs here. You didn't have 7 out of 8 days up in a row, so it was missing some telltale signs. But then what happened is normally from a climax top, when it drops, it'll drop pretty fast and pretty hard. But this really was a very mild correction. It was really able to maintain the majority of its move at this point. Now here's where the actual climax top occurred. It went up 100% in 3 weeks after already advancing 1,400% in the prior 8 months. So remember, the big thing about the climax top is this is not happening out of a base. This is happening after the stock has already made a huge move. It had already gone 1,400%, and then it was going from 35 all the way up to almost 65 in a very short period of time, in under 3 weeks. Now, if you had started counting the days, you see that there were 7 out of 9 days that were up, so there was a lot of up days there, and you did have a gap up here. So not quite the look of an exhaustion gap, but it does reverse off of that day. That could have been a warning sign, but then it has even stronger action, and that's where you're really starting to see the rally get out of control here. And remember, the idea behind a climax top is you are going to be very excited. You are going to feel like you're just making money hand over fist, and it's going to be very hard to sell the stock. But when you feel that sense of euphoria from your stock, that is a warning sign that it may be time to sell. Now, if you did not sell into that climax top, you saw a very quick breakdown in the stock. So remember, I was pointing out this little gap here that kind of showed some weak action. It was also preceded by a reversal where it was starting to show a little hesitancy in that new high ground. You found that the stock comes right back down to that price very quickly. So you get the largest one-day price drop as it goes from $64 the previous day, closes at almost $42. So that was a 29% move down, 29% that you found yourself off its high in just one day. So look, you've got to take some action at this point. So if you did miss this sign here, and you missed selling into this climax, which also, by the way, was coinciding with a split. You had a 2-for-1 split. Let's go back to the weekly on this. You had a 2-for-1 split at the very top, and right before that, you had a 3-for-1 split in a very short period of time, in under 6 months. This is what we're talking about with excessive splits. You've got a high frequency here, and you've also got a high factor with that 3-for-1 split. And that occurred again right at the top of the stock. Another sign that you could have seen that this stock was getting fairly extended was if you had done a comparison versus its 200-day moving average, you would have seen that it was over 300% above its 200-day moving average. Now remember, we were talking about with Charles Schwab that only 5% of our big winners ever get more than 200% above the 200-day moving average. And Charles Schwab was one of those rare exceptions where it got 226% above it, while Taser found itself over 300% above the 200-day moving average. So, significantly above the 200-day moving average, not necessarily a sell signal by itself, but in combination with this climactic action, it is a warning sign, and your last chance really was when you saw that huge dramatic price drop. That should have been your final clue that yes, that was a climax, and whereas before, if you had thought this was a climax over here, it was able to hold that territory. In this case, you see a severe breakdown. The volume is getting very large, 67 million shares traded in a day as it's coming down, and it just comes down very quickly. And if you didn't react, you would have found yourself losing your profits in a matter of weeks. This next chart is eBay. eBay had a very good move in 2003 after the market had bottomed in October of 2002 and then had a rally and a follow-through day in March of 2003. This is one of the leading stocks at that time, and you can see that it formed multiple bases on the way up. Now, if you had been buying out of this late-stage base, you should have known that you were putting on a little bit of extra risk. As you see a stock form multiple bases, you've got to know that those later stage bases are possible signs that it's nearing a top. Now, if you had bought this, or if you had been holding on to it, hopefully from a original base, and you had this huge cushion, how could you have gotten out protecting your profits? Let's look at the daily. So here's that later stage base that formed, a cup with handle. It comes out from that cup with handle, and you see that it kind of starts flattening out a little bit here. That's not too worrisome in and of itself, but let's look at this pullback to the 50-day moving average. The volume, we start getting a little bit of that stair-stepping volume. The volume's increasing on each of those pullbacks, and now you've got a break below the 50-day moving average. Now, this stock frequently did break below its 50-day moving average when it formed a base. So at this point, you've got to make a decision. Are you willing to sit through another base on this stock? It's already formed multiple bases. How many more bases do you think it's going to form? So breaking the 50-day moving average here is a big warning sign. And then you see that not only does it break it, but in the next couple weeks, it's not able to go anywhere near it. It doesn't really even try getting up above that 50-day moving average again. So here again, you're seeing that the stock's character has changed. Now again, maybe it's basing, but you've got to think, this is coming out of this late stage base here. Do you really think you're going to get more of a move out of this stock? This is why, again, it's really important to look at the weekly. The weekly shows you that it's already had a pretty significant move. From its original breakout at around $15 split adjusted, that was actually closer to $60 at that time, but from that $15 range, it's already gone up fourfold. So at a certain point, you start having to ask yourself, how much more do you think you're going to get out of this stock? So after the 50-day moving average is broken on very large volume, much larger than average, it starts living under the 50-day moving average, and then you get this gap down. Now, if you hadn't sold prior to this gap down, this was really your last chance. Earnings report came out and they disappointed, and a lot of people might have been thinking, well, I'll just wait for it to rally back from this news. A lot of people feel that things get oversold on disappointing earnings, and they feel like they can just ride it out and wait for the stock to come back. This stock never did. So you've got to be very wary of that strategy of just trying to wait and see what happens, because the stock just went down further from here. You see that there was a 2-for-1 split here, another 2-for-1 split. We had already had multiple 2-for-1 splits because the stock had increased so much from that original breakout. So there weren't very many signs on this one. That 50-day moving average was one of your key clues, but if you didn't react to that and the fact that you had this weakness for a number of weeks under that 50-day moving average, you could have gotten very hurt very quickly. Once a position is established, you need to pay attention to the daily action, especially if the stock has made a big move and you're sitting on a large open profit. The weekly action is going to give you a good sense of the big picture and how far it's come, but the daily action is going to give you the details that let you act on your sell signals. You're going to be looking for signals of weakness, signals that indicate a possible change in trend, and be alert to possible climax top activity. If you're in the midst of a climax run, sell your entire position. This is your last chance to get out at a good price. If the stock is giving mixed signals, you must start to sell a portion of your position. If the stock forms another base, wait for a proper pivot to repurchase what you sold. However, beware of breakouts that occur from third, fourth, or fifth stage bases.
So remember, selling is all about sticking to the rules. Eventually, you should have these rules committed to memory. But in the meantime, post them wherever you do your research so you're always reminded to be on the lookout for potential sell signals in your stocks. Especially important, be aware of the market conditions. When the market starts a downtrend, That should put you on red alert to watch your stocks closely and start looking for opportunities to reduce your exposure to the market. And one final note, a lot of your selling success will depend on buying the stock right to begin with. If you buy the stock right, you'll be less likely to have to sell for a loss and have more of a chance of establishing a cushion. That cushion in the stock allows you to make decisions from a position of strength. In our next section, we'll focus more on how to work from a position of strength with each stock and your whole portfolio. Our next topic is managing your portfolio.